Maplebear, otherwise known as Instacart, announced their earnings after the market closed. And I'm taking a look at the earnings, going through them. I'm going to update my analysis on this company and share with you if this is a buy or a sell. First, Instacart is in the delivery business, really focused on grocery. They're also delivering Costco, which is interesting. They're trying to break into delivering food, prepared food, as well as categories outside that grocery store. So they're doing deals with other retailers where the Instacart customers can order up other things. Now, taking a look at their full year financials, some things that I like: total revenue uh, went up 11%. That's really good. That's very, very good. And overall transactions were up about the same rate. I was expecting them to grow about 10%. They grew 11. That's even better than expected. I'm seeing a healthy business because revenues are growing, number of orders are growing. Those things look really good. Gross profits going up. And overall, the company is beginning to establish a very good scale. As they get bigger and bigger, they're going to become more and more profitable and generate more free cash. As they get bigger, they'll be able to reduce the percentage of operating expense against the business. You see in Q4, they did really well. They moved it down from uh, operating expenses were 7.1% of overall gross total value, and it went down to 5.9. So you can see that the scale, as well as some cost reductions, R&D is going down. Probably their platform is nice and stable. It's just making them more profitable. That's great. That's what I want to see in a growing business that's maturing. Cash from operations grew faster than revenue. Very good. And overall, their CapEx wasn't too bad. And overall, their free cash flow is a tiny bit lower than what I expected. I'm going to use the free cash flow, which is cash from operations minus CapEx, and use that in my valuation of the company using free cash flows. So Maplebear Instacart is a $12.5 billion market cap company, which isn't bad at all because their revenue is $3.3 billion, and you're only paying maybe 4 times revenue, which isn't bad considering the category that they're operating in. Their forward P is 31. That's a little high, and analysts think it's fairly priced. It's also a buy. Historically, they've grown really nicely, and I like that they have the grocery delivery business. That's where they specialize. I think it'll be hard for Uber Eats or um, DoorDash to compete against them in the grocery store, and they can take that model and extend it to other retailers. So I think that's real good. Overall, their gross margin 75%. That is great. And you see, as they get bigger, those gross margins keep getting bigger as well. So that is very good to see. Overall, their free cash flow margin's 21%. Anything above 20 is really puts a smile on my face. So very strong business, very valuable business. Now, 22 analysts look at the company, and on average, they think it's just slightly discounted. And after today, because the stock is selling off, it'll be nicely discounted based on the price targets that these guys have. Now, when we go to fiscal year 2025, the company's going to grow at just a tad bit under 10%. The profitability is going to expand nicely and continue to expand in the future. And the forward P will drop to 29.69. So I use these figures along with the cash flow to value the company. Using the updated information and putting that data into my valuation model, I think that Instacart is discounted by 39%. And if they drop an additional 10% in the after hours, make that 49%. That's a hefty discount on what I think is a really neat company. They're growing really well. They're really establishing a name brand for themselves. Overall, this is completely a takeover target. You think about some of these bigger businesses that want to get their customer list and they want their clientele, they would be a nice acquisition because they're a pretty reasonable market cap company, 12.5 billion. I can name 20 companies that have more than that in cash on their balance sheet, ready to go. Their free cash flow from operations minus CapEx is what's building out this forecast. And it is a very reasonable forecast. They're expecting to grow in 2025 by 9 to 11%, but their cash flow growth rate was higher than that, substantially more like 14, 15. I'll play it safe and grow cash flows by 10% in the first 4 years, then 5% after that. The intrinsic value of all those cash flows is 18 billion. They have more than $2 billion of cash sitting on that balance sheet and no debt. So their overall equity value is 20 billion. So it provides a really nice discount of 62% if we look at those cash flows. Overall, I think it's fairly priced based on earnings per share, especially if we're going to see a reduction in the stock price of 10%. So this is a really interesting stock. I like the business. I think these businesses are here to stay. These businesses are what people want, convenience, and other people want gigs. So they're willing to deliver for Instacart. So this is a very desirable industry for me. With what will soon be a 49% discount, I'm a buyer of Instacart. This is a buy all day long. I think this stock could continue to go down in price because the market is selling off. So I'm gonna uh, buy over time, and I'm gonna DCA my purchases of Instacart stock and load up maybe $10,000 as an investment in Instacart and kind of have that as my starting point. I think I'm very optimistic of the company. I think most definitely they can continue to grow, maybe become a $10 billion revenue company. I think the market cap can go up to about 100 billion at some point and really reward stockholders in the future. So that is my video on Instacart. Let me know what you think. What you think of the Instacart service, what you think of the stock, the company, and good or bad, I'd love to hear your thoughts. Thanks a lot for watching.